Welcome back to another Stock Market Open Live. Today is a very special day. How special is it? Well, we have the Jackson Hole speech that everyone's been waiting for. Stocks typically in 5 out of the last 6 Jackson Hole meetings have sold off after Jay Powell's rugging and tugging. So we'll see what kind of rugging and tugging we get today. Who knows? You know, the probably the toughest thing is going to be unpricing fully any chance of a 50 basis point cut from the Fed, which doesn't appear likely right now. So we still have some unpricing to do. And then the next bit of work that's going to be a bit challenging is how rapidly the Fed will signal that they'll be responsive to weakening employment. See, if we know that Powell says risks have become more balanced, but does that necessarily mean with a move in rates we would, or a move in the unemployment rate, we would see a rapid move from the Fed? Well, not necessarily. So it's gonna be really interesting. We've got a little bit of work to do and a lot to see in terms of what the Fed wants to bring out to us. So. But with that, you do have markets somewhat trying to rebound a bit today. If you take a peek at L Markets, you can see that the Qs are up about 1 percentage point in pre-market. Big important line here, 476 was a big play, very much in play yesterday. You got bounces off of 476, you broke through 476, which led you to fall into the close. So watch 476 on the Qs. Tesla up about 1.1 right now. You've got Bill.com reported earnings up about 3.7. Disney's up about 39 basis points. Redfin up 2. Nvidia's up a little bit, 1.29. Yep, there we go. Touched that soundboard, my bad. Anyway, BTC, look at that. Perfect bounce. You just can't make this stuff up. You know, I know there are people out there that are like, oh, you know, technical analysis, it's all voodoo, whatever. Like, okay, whatever you say, it just happens to keep whacking the lines. What's going on? Oh, that's what's going on. Okay, there we go. Anyway, kind of wild. So you've got a solid bounce here at 67. And then you've got... let's see, what else do we have here? Oh, let's see here. I think you just had Bostic do some yapping, so let's go find out what good old Bostic had to yap about this morning. And let's see here. So, Bostic... Oh, he's going to talk about payroll revisions, too. All right, let's take a look at this. Let's see here. Let's just take 1 second to get ready. And then Jackson Hole Day. Oh, I can't believe it's Jackson Hole Day. The day has come. The moment is at hand. All right, there we go. Okay, payroll revision didn't really change jobs view that much. Oh, okay. Yeah, that's not great. It says inflation came down more than he expected. Well, that's good. Makes sense to pull forward my view on rate cuts. Oh, that's actually good. Inflation dashboard is still flashing red. Inflation is not particularly close to the Fed's target. Passive tightening via lower inflation is a thing. And we're close on starting to normalize. Yeah, okay. Well, again, big thing now is what are we gonna get in terms of a Fed that wants to highlight its interest in preventing a recession versus fighting inflation, and you might end up getting a Fed that doesn't mind a recession to make sure that the inflation demon is fully dead after all. Anyway, let's listen into here for a moment.
Growth has been slower than we thought it had been, and it's very hard to pull off a soft landing the way the Fed is trying to do, although they look like they can do it. So I think at the margin, the Fed is more oriented toward labor markets, which means more inclined to cut. And I do think that the basic scenario of 3 cuts, 25 basis points each between now and the rest of the year is the base case.
yesterday we were having this debate about whether they should cut by half a point. And a couple of reasons for that would be, number one, that rates are so much higher now that kind of as a percentage of where they are, it's not as big as it might be later on if you had to do more of playing catch up. And maybe more importantly, inflation expectations are down 60 basis points into spring. Michael Darda was making that point. And Bostic himself just said to Steve that passive tightening is not the Fed's goal. And passive tightening via lower inflation is, quote, is a thing. So inflation's coming down, inflation expectations are coming down. Even as he said, his inflation dashboard is flashing red. I mean, you could make the case for a half-point cut as potentially leading to a better economic outcome, especially if you need more hiring right now.
Yes, but I think if the decision were today, the September 18th meeting were actually today, it's much more likely that they'd do 25 basis points because they'd like, I think, to be consistent and smooth about it if they could. And so I think that's more likely at the moment. But if we see, for example, a disappointing print on jobs and the unemployment rate and other aspects of labor markets, yes, 50 basis points could come into play, as you suggest.
Hey, Roger, we had an interview with Senator Warren, and I went back to the way that the price control or price gouging, whatever you want to call it, the way that was received. And I think it was fair to say that you had some criticism from both sides of the aisle. I had the Washington Post said it's a gimmick, we need real solutions. Jason Furman said not only is it a policy that won't work, it could actually be counterproductive. I just want you to weigh in on it. I mean, we can acknowledge that the pandemic caused supply to be tight. There was a lot of stimulus that caused demand to be very high at the same time supply was tight. That's enough of an explanation right there, I think, for what happened. Do you think how much of the 40-year highs in inflation was caused by corporations taking advantage of that situation and being able to gouge on prices? I'm just wondering if you're someone who
thinks... In my view,
that...
Joe, in my view, very little. It is true that grocery margins during the pandemic rose above long-term historical levels and haven't fully returned, haven't fully come down.
They're at pre-pandemic. They're at pre-2019 levels. My colleague Sarah Eisen.
I've seen other data, but
what are the margins now?
In any event, my answer is very little. But
very little.
And
okay.
I also view the proposal, the first ever ban on price gouging at grocery, I view that essentially as jawboning. That would not pass the Congress, whatever the makeup of the Congress is. The Harris campaign knows that. So it's a form of jawboning, which is a very old, tried and true technique, essentially saying we're going to watch very closely as to the pattern of grocery prices. But let's step back a second. I thought that she struck last night a bit of a surprisingly centrist tone. She was very...
That's been the goal of the Harris campaign so far, to try to distance themselves from like defund the police and some of the further left things and try to central.
And her comments on Ukraine, Iran, North Korea, very hawkish. Her comment on lethal military capability. And then her basic proposals, an expanded child care tax credit, deeper incentives to increase the supply of housing in this country, an expanded earned income tax credit, including low-income childless workers, and finally, continuing the enhanced subsidies for buying insurance under the Affordable Care Act. These are very appealing to the middle class. I personally see them mostly centrist. Stayed away from some of the flashpoints.
Right.
Whatever I might think.
So
there wasn't much emphasis
Senate.
on climate, for example.
Maybe we should have just assumed that was coming. Tell me, I got 5 seconds, Roger. Thank you. We're coming right
Always
back.
a pleasure, Joe.
Okay, thanks.
All right. Oh, boy, they cut him out fast. As soon as he starts talking Harris, they're like, get him off, get him off, get him off. Anyway, okay. So, yeah, I'm kind of watching this Bitcoin bounce here. Pretty perfect. And comes after a day of pain yesterday, which is not, terribly surprising that you could get a day of pain leading into J-hole, as well as when you get Collins and Harker yesterday. really trying to help unprice that 50 BP cut. I wrote down a little bit about what Bostic just said. When he says we're close, that implies September. When he says it may make sense to pull forward my view on rate cuts, that implies from year-end to September. When he says the payroll revision didn't really change my view on jobs much, that implies 25. When he says the inflation dashboard is still flashing red, that implies 25. And when he says inflation is not particularly close to target, he implies 25. So I think the Fed, frankly, is being pretty crystal clear so far. I mean, if you take Bostic, Collins, Harker, they all probably already know what Jay Powell will say today. And the consensus seems to be 25 in September from all of them. Right now, markets are still pricing in they're pricing in 1.26 cuts. So, let's write that down. September, 1.26 cuts priced in. That likely needs to go down to 1. So you've priced in a quarter of a rate cut too much. Then you're still sitting for November at 2.5 cuts. 2.56, I think it was. 2.54. And then December, you're at 3.9. Oh, that went down a little bit. December, 3.9 cuts. And January, 4.9. So, problem with that is, if you realistically have 1, 2, 3, 4, you basically have to get a whole extra price, 25 BP cut unpriced out of the market. So, but that volatility will probably come with the election and some other things. Anyway, yesterday, obviously, we saw the 10-year pop. But it's worth looking at that sort of broadly on an overview. Let's take a look at this. It shows you how much I've had a rotation down. Let's see here. Okay. Let's see here. So there it is. So you can see this rotation down here on the right. And the trend has been pretty clear since about April as we've sort of come down here. Pretty incredible. So let's listen and hear for a moment.
Upgrades today as well. But we will begin with the Fed chair's speech, which comes just days after the Fed minutes indicated that policymakers do see a September rate cut as likely. Now, Sarah, we got Bostic saying that passive tightening is a thing and that it might make some sense for him to bring his rate cut view forward.
Yeah, but he wasn't as dovish as he could have been. He also said that inflation is not close to target and we've still got more work to do, which doesn't exactly channel where the market is right now. Look, as far as Jackson Hole is, it's hard to imagine that the Fed chair can go into any kind of specifics as to what the market really wants to know, which is how big is the first cut going to be? He's not going to pre-commit to that. He has no incentive to do so, especially with another PCE report coming next week on inflation and a jobs report coming before the Fed meeting. And then what does the path of Fed cuts look like after the first one? He also can't really do that yet because it's hard for them to know how much they have to do and what the path is going to look like. So those are the big market questions. And it's hard to envision, David, that the chair can be very specific on that. The expectation is that he will give a nod to the fact that they have transitioned into a place where they're more worried about jobs, for instance, and feeling good about the inflation risk, and that they are looking to move to cut rates as soon as September. But that's already in the market.
Right. What's changed between the last time we heard from him at the press conference and now?
More evidence that inflation is looking benign. Got the CPI report. Inflation expectations continue to come down to more normalized levels. Look, the last PCE, and this is the Fed, what Fed targets, is 2.5%. Their target is 2%. And that has continued to move in a good direction now 4 months in a row. And then the jobs numbers have gotten increasingly soft, not sort of collapsing in terms of not seeing a pileup of layoffs. We're not seeing extreme stress. We're seeing a tick up in the unemployment rate, as it should be with the Fed being so restrictive on policy. And so they have two mandates. It's to keep inflation in check and to keep joblessness from skyrocketing or from going up, to keep jobs intact. And so now we're a little more worried about the job side of their mandate, and that's the backdrop to this whole speech. Which is
Yeah, Sarah's like an hour early today.
100 basis points of cuts before the end of the year. I mean, one surprise could be if he expresses confidence in the economy, and then maybe the market walks back some of its 100 basis points of cuts. Let's bring in senior economics reporter Steve Leisman, who is there at the Jackson Hole Fed Summit. He's been speaking to other Fed policymakers. What's your expectation at this point, Steve?
So I think Powell will lay down something of an important marker here, Sarah. Whether or not that marker is priced in is a different conversation from where we are in the chronology of things. Look, the Fed has been out there fighting inflation for, if you count it up, 30 months. I counted from the November 21st speech. I remember it was a Thursday at 4:30 where he dropped the word transitory and kind of said, hey, we got to start reversing course. So we've had 11 hikes from March 22 to 23. 525 basis points, restrictive, higher for longer period, $2 trillion off the balance sheet. I think this whole process we're looking at here has come to an end. You're right, Sarah. A lot of it's priced in, maybe not all of it, because I think what he does today is really say, hey, we are much more confident that inflation's headed to 2%. We're much more focused on both sides of the balance sheet. I agree with you about Bostic that he was maybe a touch more hawkish than you would expect, but still, it's a change. If you notice what he said to me when I said you had one cut before, is it multiple now? He goes, that's in play here. So he'll probably affirm this market expectations for at least more than one cut. And then the other debate that's happening is this issue. Okay, you take 100 off, but you're still restrictive. And that gets to this passive tightening thing. Right now, the Federal Reserve is as tight as it's ever been because inflation is low while the funds rate has remained 5.38. So on a real basis, the Fed's as tight as it's ever been. So what does that mean? It means I think that the chair makes it clear we're entering a new regime here. Not necessarily a regime of stimulating the economy with rates, but a regime where we're done being restrictive and now we're going to start a regime of being less restrictive.
I think one mystery, what I am eager to hear him say, which I think there's some differing opinion on from economists and from policymakers, Steve, is how worried is he about the outlook? Because that will be a clue, right, as to how he's thinking about what comes next.
You know, I think right now what I'm hearing about the Fed's view of the economy is it remains relatively strong, but there are concerns and risks out there about weakness. And you know the same data that I'm looking at. Jobless claims have been sort of unchanged, the 4-week moving average over a, 1-year basis. GDP is still running 2.5 to 3%, depending upon how you look at it. So I don't think they see very much weakness out there. I think there's the risk of weakness and concern that some of the lagged effects of monetary policy start to bite now.
Steve, appreciate that.
Yeah, that's definitely the risk with jobs. I mean, you should see there's some restaurateurs are freaking out. So I think you're going to see a lot of restaurant bankruptcies. I've been really studying the industry, and it's going to be tight. You've got also here, look at this. This is wild. So for the August 16th real GDP estimate, you have 2%, right? And you've seen this sort of edge down right here. But you want to see something wild. Take a look at this right here. After this morning's housing starts report from the U.S. Census Bureau, the nowcast of third quarter real gross private domestic investment growth decreased from 0% to negative 2.4%. Notice how they put this here in like the unhighlighted portion. I remember I made a video on this when it was going to 0%. And I'm like, okay, it's kind of odd when it goes down to 0. Well, at least it's not negative yet. Well, now the estimate's freaking negative. And I want you to see it right here. Take a look at this. Real gross private domestic investment, right? Same line. Real gross private domestic investment. And now, 4.99. Thanks for the 4.99. Are we going to fill this gap by end of the day? The volatility is crazy. Oh. Based on how prior Fed Jackson Hole meetings have gone, the answer is probably. But anyway, let's take a look at this. We're now, according to them, negative about 2 and a bit, which would put us right here around the beginning of 23, where we did sort of, beginning of 23 after the 22 here. Some people thought maybe there was sort of like a technical or rolling recession going on. A little bit of an anomaly to have that sort of negative, because usually negative spikes in real domestic investment, private domestic investment, only occurs during a recession. Here, very, very briefly, did you go down to 1.2% here in 2016, but large magnitude declines occurred in recession. Here it didn't. You got down all the way to 4%, negative 4%. In 86 without recession. Recession. Not here. Got down to negative 6% without recession. Recession. Not here. Down to negative 21%. But I think this is a more, is that Korean War timing? I don't know. And then over here you were down at 29%. So, if you go, let me see here. Korean War ended 1953, and the start was 1950. Okay, I'm going to remove that one. So if I remove the Korean War, and I just go on from there, I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 cases this occurred in recession. And how many times did it not occur? 1, 2, and then you could argue that's 3, 2 to 3. So, what is that? Let's call it 3 just to be generous. 27% of the time you get this figure going negative, not in a recession, and 72% of the time it does go negative because you're going into a recession. And, this is a very interesting sort of sub-headline here. So, kind of wild. Let's listen in over here.
Rate cuts the way the market is pricing at the moment.
Michael, how does your view rhyme with Torsten's, if at all, and what does it mean for the stock market?
Yeah, well, I think it's a very bifurcated backdrop still, and I think we're seeing more weakness creep up from the bottom half than strength trickle down from the high-end consumer businesses. So, I think we could corroborate all this macro data, which I think, there's enough strong data and there's enough weak data to pick your own narrative. But if you look at the earnings data, and particularly in mid-cap stocks and small-cap stocks, the most economically sensitive groups, their estimates continue to fall. In fact, estimates for this year are now below realized earnings of 2023, and 2025 earnings are also continuing to come down. That said, large cap stocks, which have certainly been the strength of the market, their earnings continue to remain resilient, and they will be the last to fall and won't fall until we really see a bigger decline in the labor market.
And that's what we're seeing, Torsten. I mean, to push back on your view, we're seeing a decline in the labor market. Unemployment rate is up, job openings are down, sentiment surveys are pointing to weakness. That's the thing that the Fed is focused on.
Well, but if you look at layoffs in the JOLT survey, is at the lowest level since 2001. No one's getting fired. Same thing in the Challenger Gray and Christmas survey of job cut announcements. It's trending down. If you look at the one notices, which is a leading indicator for jobless claims, it's also suggesting that jobless claims will be lower over the next 2 months. So the very important nuance in this debate about the labor market is that there is weakness, but that weakness is mainly becoming an issue because labor supply is growing. It's not because people are getting fired. All indicators of layoffs are at record low levels. So in that sense, firms...
He's right about this. Layoff levels right now are still low. So what happens when that normalizes?
I mean, with the consumer, there's definitely signs of slowing.
Well,
as
hold on. Target this week reported that everything was fine. CEO
value
of
play.
Walmart, well, Walmart was saying there's no broad-based
But where
slowdown
do
for
you
the consumer.
go when times are tough? You go to Target and you go to Walmart.
Well,
and
but if you look
trade
at the
down.
weekly data from Redbook on same-store retail sales, it's very strong. So across the board, it is completely misguided discussion. This whole idea that the consumer is crashing, there is no
Not crashing, not crashing. But I do have a chart on delinquencies for credit card loans, and I mean, it's way up.
But that's only for certain segments of consumers across the board. In the aggregate, the latest retail sales for consumers was just fine.
Oh, I love this.
In some, I mean, I think the message today from Jay Powell, very importantly, will be that, yes, number one, we are cutting in September.
There's my chart.
But after that, we will begin to see more evidence that the data is maybe not as bad as we're expecting. And I think he also will clearly say, we just don't know yet what will happen after September. I completely understand the idea that we may be above our star and we may be restrictive, as you talked about earlier. But the question is, are we in a hurry to cut rates a lot? And the answer to that is absolutely not.
Michael, remind me, is the House view at Piper net bearish? Is recession your base case?
So our economist Nancy Lazard does see recession beginning in the fourth quarter. Our view on equities, we've been bullish since October of 2023 on this view that we're going to have softy locks, which is a moderation of economic activity and lower inflation, and lower rates would be very good for equities. We changed that view at the end of July with the view that inflation fear has been largely priced out, and obviously we've priced in a ton of Fed rate cuts. And now we're going to be more focused on growth data and activity data. And I think we're going to see, and what we've seen in the last month is we're going to see more of this, is a lot of realized volatility in the market. When we get good data, we're going to get relief because there's now budding recession fear. But if we see bad data, we're going to see the markets sell off, I think, equally as sharply. And so we're seeing, I disagree with Torsten's kind of binary view that everything's all great. And again, I think we can look to the markets, and it doesn't have to be a binary answer, but if you look at market leadership, we continue to see leadership in higher quality stocks, companies with good interest coverage, high profitability, better fundamentals. That's not the type of leadership you would be seeing if the economy was strengthening or strong. It's quite the opposite, historically speaking.
You want one final word, T?
Well, one final word, of course, is that remember what creates recessions is normally a shock to the economy. And that shock, of course, was COVID. It was the financial crisis. It was the IT bubble bursting. What is a shock to the economy today is the Fed has raised rates.
Black Swan, bro. Did you see the carry trade coming?
And to the economy finally begin to slow down. Why should it slow down here in August? We can still wait a good while longer. The data still continues to come in very nicely. The Fed has plenty of time to think about cutting rates.
We will rely on both you guys. I know you both track.
This guy makes me nervous.
Good discussion ahead of Powell. Have a good weekend, guys. Thank you, Michael.
Sarah doesn't like him either.
When we return, wrapping up the Democratic National Convention, the VP formally accepts her party's nomination for president. Last night's speech setting the tone for her race against former President Trump. We'll talk about it. More Squawk on the Street straight ahead.
All right. Well, we are getting closer and closer and closer to the time that J-Hole goes live. We'll cover it. Obviously, it's going to be the news of the day. Yesterday was DNC and a little bit of a market sell-off, partly in anticipation of J-Hole. But also now we have this full speech that we'll be covering. The question for markets now really is just how hawkish of a Fed are we going to get? I think this chart, by the way, that we just reviewed is really interesting. I mean, I'm throwing it in over here so you can see it. So I'm just going to throw, I'm going to also put in the screenshot of the Atlanta Fed so we can track that. But the Atlanta Fed's GDP index starting to rotate down based on some of that Q3 data. So let's write this down here. We're going to say Atlanta Fed and reduced real GDP outlook to 2%. Byline indicates real gross private domestic investment growth. Spell that correctly. There we go. Last week fell to 0%. and this week fell to an estimated negative 2.4%. And when we look over here, this is post-Korean War. Post-Korean War, we've seen a negative year-over-year percentage 11 times in recession and 3 times not in recession. So basically, I guess I should divide 3 out of combining them, right? So 3 out of 14. 3, 6, 9, 11. Yeah, it'd be 3 out of 14. Oh, that's even worse. So that basically means, that means 3 out of 14, or 21.4% of the time this has occurred not in recession. And the inverse then would be 11 out of 14 times, or 78.6% of the time this has occurred in recession. That's fascinating to me. That just sort of contributes to all of the data that we see. So I don't love that. Okay, interesting. I don't know. What does anybody think about it? Scott says that means we're screwed. Oops. Yep. Let me write that down. Jackson Hole at 7 a.m. PT. Make sure that's we got that here. And there we go. Okay. And what we should also probably do, usually on these, honestly I don't usually do a thumbnail. Let me do Jackson Hole speech by Jerome Powell, Fed. And I should quickly throw on some form of Powell with thumbs up, eh? How's that sound? I think that'll be good. Powie wowie with thumbs up. There we go. Look at that. We've done a thumbnail. Great. Kevin, where are you on the recession versus no recession scale? Yeah, that's actually a very interesting question. So on the bear bull scale, I'm still sitting at 2.9 on the bear level. That's a great question. On the recession versus no recession, I'm probably in the neighborhood of 70% chance of recession within the next 12 months. So probably more likely 9 months. That's my opinion, right? Now, why is that important? Because, a lot of the stats that we've been seeing are like, 20% chance of recession. That's for this year. When you ask these folks who have percentages of recession, what they think about a recession occurring within the next year period, rather than just at the end of this year, then the number can change relatively rapidly. So we'll see. Anyway, 10-year Treasury right now down about 2.9 basis points. You've got gold sitting up at 25.36, 77 basis points. You've got you had Bitcoin there. There we go. You've got Bitcoin that's sitting above the trend analysis line we've been watching there, 60,702. And what else we got? Pre-market. Loan Depot picking up 4.61% in pre-market. Nvidia is trying to pick up a bit as well, 166. Tesla, 139. Bill. What else do we have here? Q's still holding on to that 1%. All right. So let's see here. Good question. Would be interested to hear your thoughts about DJT stock and what it might do, considering it makes no money, burning through cash in the end of the year, or end of the near SEP Trump officers lockup, basically. Well, I mean, typically, you just sort of look historically at what happens to companies when there are large lockup expirations on unprofitables. You usually see selling, and that doesn't mean you're going to see selling again, but it just wouldn't be a surprise. And so then you have to ask yourself, okay, well, I think about it as, does Donald Trump have a need to sell? I mean, they've raised a lot of money, but could additional funding help them? Is this sort of an egg that'll break open and sell shares on publicly? That's probably the biggest risk there, huh? So, can we use the bingo card from last Jackson Hole speech? I don't even remember the bingo card of the last Jackson Hole speech. But we could probably just reopen it up. Kevin watching gold is so bearish. Kevin, well, if they looked at the head and shoulders on the weekly and daily, they would know something is coming. Thanks for the other $5 there. Talking about the head and shoulders. Will banks want to lower rates with so many bets on TLT? Well, what does people having bets on TLT have anything to do with banks wanting to lower rates? The second Powell and the Fed lower rates 25 bips, all your money market funds are going to go, it's just part of the game. So, but it's okay. It's Fed funds rate for a reason. Let's go make a bingo card. All right, let's call it, there, we got to switch over. Switch mics. See, I used to have this problem where if I just used the same mic, the volume would really drop off. But now it should be pretty decent when I face this way. So hopefully you agree. I've been working on positioning for that microphone. All right, let's get J-Hole in here. So let's go with 1, 2, 3, 4. Then let's go. Oh, come on. Here we go. 1, 2, 3, and 4. All right, who's ready for some Jackson Hole bingo? So let's do a freebie here. Powell shows up. All right, now this is gonna be the tough one. All right, so we're gonna go with inflation job is not done. We're gonna go with let's see here, job market still, or unemployment rate still historically low. This is bearish, by the way. This is bearish. Then we'll go with close to cuts at a slow, measured pace. This would be 25 BP sept, right? I'll put on the edge case over here. Implication is 50 BP is dead. Obviously, we would expect to see some generic commentary, like, let's throw some easy ones in here. Data dependent. Then, if we were to see some meaningful slowing in jobs, we'd have the capacity and willingness to cut faster, which again basically is going to imply 25 for September. And let's see what some of your comments are. Data dependent. Yeah. Where is that button?
Dependent.
Well,
Data dependent.
Japan. Speech is not more than 10 minutes. Geopolitical tensions. We're not even thinking about raising interest rates. Ooh, that's a good one. Okay. So, this was basically an implication that we've reached peak, right? So let's write that down. Reached peak interest rates. We'll throw that down. Worst case scenario is reigniting inflation because they have the tools to deal with the job market and the issues there, but not necessarily inflation. Already 3 minutes from the bell. Jeez. Bow tie. Kevin runs out of coffee. We aren't political. Non-farm payrolls revision. Yeah. Revisions data already mostly known. Did not change much. Then let's see. Let's say meaningful slowing in jobs. We'd have the capacity and willingness to cut faster. Something about like how much room they have to cut, right? We have a lot of room to cut. in case we need to. You know, it's just and that's just one of our tools. One of our tools. Keep in mind the second tool would be quantitative easing. Yeah, dual mandate. That's a good one. I mean, obviously, we should throw that one in. That's true. Dual mandate. We should say better balance, right? Better balance in risks. That should be pretty straightforward. Global easing cycle outside Japan. Let's see here. Energy cost. Kevin gets upset about Nope, that's not gonna happen. Yeah, I think the 50 BP cut it dies today. That would be my guess. And so, I don't know. I don't know what else to write down on this. You know, I guess we could throw in soft landing is possible. Then, maybe what we could do is stress in some consumer segments like restaurants, travel, credit card, autos. We have yeah, you could probably still see something on you know, the economy is still growing you know, strong, and we could see some modest undershooting of GDP would be acceptable to ensure inflation is resolved. You know, they're not going to say dead. All right, we got a few more to fill in there. So we're going to get to the bell, though. All right. So a little bit of a drop just going into the entry there on the Qs. Tesla, though, wanting to run up on the open. You've got TLT up a little. You've got NVIDIA bouncing about 163. Let's go ahead and get that opening bell. Oh, thanks, Jens. Kevin for President 2028. Let's
get the opening bell here in the CNBC Real-Time Exchange and the big board. It is USTA Foundation, the charity arm of the United States Tennis Association, celebrating 30 years. And at the NASDAQ, Actuate Therapeutics, a biopharma focused on treating high-impact, difficult-to-treat cancers, commemorating its IPO. Despite the green arrows this morning, guys, some discussion of the companies that reported yesterday, earnings that is, of the 20-plus names we got. I think 16 were down.
All right. You've got Qs, a little bit of a red candle on the Qs. You've got Peloton's down 4.18% right now, so a little bit of pain there on Peloton. Tesla, though, it just keeps rocketing up a little bit there, sitting at about 1.94 right now, so a good trend to the upside. Let's listen into what they say here.
That was well above the consensus. They raised their same-store sales growth guidance, which a lot of analysts, Wedbush putting out a note this morning saying still looks conservative. They raised it to 8.5 to 9.5% growth. That was from 4.5 to 6.5, where they saw nearly 10% traffic growth. So clearly it's working. And the CEO, Brett Schulman, was on Squawk Box this morning and talking about how consumers see it as a value play, and that has a lot to do with prices. Listen to what he said.
That's been one of the things that has really helped us drive our success and drive our traffic. If you think about from the end of 19 to the end of 23, we only raised prices about 12% during that time period. CPI went up about 18%.
So another advantage that he says beyond the state.
Yeah, here's a restaurant that's just killing it right now. Restaurant group, Kava Group. But anyway, you know, it seems to be like the winners of the winners, right? Kava, Chipotle, Starbucks, McDonald's. These are the ones that are killing it, and everybody else is suffering. Tesla up about 2% right now, bobbing around. See if it can hold on to it. That's holding on to it right now. 2.1 now. Disney 29 bips. Got 72 on the Qs, NVIDIA 1.5, Apple 0.5%. Bitcoin kind of stabilizing a little bit right here as we go into Jackson Hole. Jackson Hole speech again starts in supposedly in about, what do we got, 27 and a half minutes here. Now, the big one for me is I'm curious, where are we going to go, or how are we going to fill out the rest of this what's it called? Bingo board. We need some more bingo. Jackson Hole. Let's Google a bit what to expect, and we'll pick some things. All right, so here's the Doomberg.com, what to expect. All right, let's see. Investors pricing in the 0.25 percentage point. I mean, I think it's pretty clear that we're going to get a rate cut implication here. Ooh, Tesla just rocketed. Tesla just popped up now to 2.5%. Let's write down a clear. Close to cuts, 25 BP. Okay, we already wrote that down. Okay, so that one's pretty good. No regional bank or slated to speak. Ooh, something about banks. That could be interesting. Reference to banks being stable. That might be useful. Though some risks. And then maybe, how about this? Not loosening would be further tightening. That might be useful. Okay. Let's see here. Andrew Bailey, Bank of England, will give a speech at 3 p.m. Let's see. Panel discussion Saturday, focus on reassessing the transmission, other attendees, blah, blah, blah. This is just sort of more of a schedule. Okay. Jackson Hole. Oh, J-Pow. No, it's all pretty straightforward. I think everybody's kind of copying the same Bloomberg article there. So, well, you only got a few more things to fill in there. Purple tie. Yeah, that's a good one. Purple tie. I'll take it. Thank you. Tesla now red candling a little bit here. Qs are still sitting stable around that 73 level. Bill.com. Whoa. Bill.com was literally, look at that. Bill.com was literally negative. What? I'm sorry, they were positive like 3.5%. And now all of a sudden they're negative 7%. Wow, what a U-turn on Bill.com there. That's crazy. Just dropped off a cliff at the open there. It's still somewhat dry. It's trying to create a bottom there. We'll see. Tesla, yeah, getting some red candles now on Tesla. Going into J. Powell. Yeah, ooh, NVIDIA doesn't care about J. Powell. Look at that. Nice little rocket ship on NVIDIA. Wow, Loan Depot up 5.3%. Rocket Mortgage up 1%. United Wholesale up 0.3%. Small cap Russell 1%. And Palantir up 50 basis points. Pretty benign day. I mean, it doesn't look like there's really any freak out at particular stocks. I think the only freak out really is Bill.com. Everything else seems pretty chill. You've got the Qs at 80 bips. Not bad. Not bad. Intuit is down 5%. Is that true? Oh, I've been waiting for that one to sell off. Oh, look at that. Right to my 630 line. How do I happen to have a line there already? It's sort of been bobbing around that line. That's why. Look at that. It's really been magnetoed stuck here. Ooh, Tesla almost a full 3% now. Look at that recovery. Okay, so let's get a few more things here. Let's see. J-Pow says, not my job. That's funny. Let's see here. We're open, have the tools, labor market softening. Yeah. I really want to put a lot more labor market stuff in here. I think that would be very reasonable. Soft landing, these have been somewhat generic. I mean, there's some good ones in here. Not loosening further would be tightening. Yeah, you're right. I guess we really didn't throw much in here. Just that about jobs, just that a meaningful slowing in jobs. We'd have the capacity and willingness to cut faster. Willingness. There we go. Okay, let's now throw in, how about we go with jobs, we'll say, how about we go with Oh, we put revisions data mostly known, did not change much. Some reference to the SOM rule, maybe? Some rule being a statistic, abnormality, but not a definitive rule. We could see some kind of casting away of that. We could see layoffs still below normal, but if normalized, could spike unemployment. I don't know if we'll see something like that, but it could be interesting. A lot about jobs here would be great. Another weak jobs report could call for a larger than usual cut. Implies 50 BP, right? So, okay. I think that's fair. And then, let's see. Weakening jobs market. Ooh, this could be good. Could lower the neutral rate. That would be big. That would basically say they would cut more than, what's currently priced in is getting down to 3%. If the neutral rate was down to, say, 2%, they would cut even more. So that could be interesting. I got one more here. Election independence. Yeah, I guess we could write something down for political independence. I think that's pretty good. That's a pretty good bingo board we got there. All right. Let's see. What do we have? Okay. Let's see here. Okay, good. So, very well. What do we got? Tesla still holding on to these numbers here. Not bad. Bill.com, though, now down 8%. My goodness. And you still got 80 basis points there on the Qs. So, we'll see what we got. I do know that we have this.
Coupon code expiring soon.
It's because we scheduled to do a flash sale for Jackson Hole. I haven't pitched it yet, other than the little banner at the bottom, but we got a little flash sale going on for those courses on building your wealth. If you want to check it out over at meetkevin.com, we expect to, or for that to expire tonight. It's Jackson Hole days already here. It's kind of crazy. Tesla now up 3%. How cool. But yeah, we'll have a course member live stream again today. We'll do some fundy analysis together. Chat with some of you about real estate. Comes up a lot. Whatever questions you have, we'll chat about. So, and we'll get you a blue wrench too. So, okay, cool. What else here? Intuit. Yeah, look at that. Playing right there at the line. Bill.com. I don't know what happened to Bill.com. I mean, it seemed like it had good news, and that's why it was up in the pre market. But all of a sudden, it's tanky doodling. Ubiquity actually was down pre-market like 7%. Now it's only down about 3% I'm seeing here. So it's recovering. Bill.com Q4 beat. Bill.com Q4 revenue beat. They announced the $300 million share buyback program. Wow. Q1 revenue forecast beat. Q1 adjusted EPS slight miss. I guess maybe that could be it. But boy, that's punishing. What a punishing move right there. That's crazy. Just crazy. All right. Listening over here. We got about 19 minutes to go before JPAL.
Financials. He joins us now. I mean, generally, when I look at, J.P. Morgan, Gerard, or Bank of America, or Citi, I mean, Goldman Sachs, pretty good years for the stocks. As we get ready potentially for rates to decline, are we going?
Ooh, Bill.com is now about 10% down.
Bonds from these banks?
David, it's going to be interesting because, as you pointed out, many of these stocks have had good years so far, year-to-date performance.
Red Robin down to $4.20. I think that one's going to go bankrupt.
And so I think what the stocks are doing is they're anticipating that the Fed will cut rates. It will be beneficial to the banks, and we'll start to see an improvement in their revenue growth as loan demand comes back in the economy that many of us expect to be a so-called soft landing. So if you go back and
What about cake, cheesecake? Well, I'll take a quick look at them. Cheesecake's about a $2 billion company. Let's take a look at their profitability really quickly. Cheesecake's got a fantastic reputation, stronger reputation than obviously something like Red Robin. But let's go to. I'll do a quick look here at Cheesecake. Okay, here we go. Let's grab their. Okay, here we go. So Cheesecake cash flows. They actually have cash flows, which is good. So you've got positive cash flow from operating activity, 94 million and 101 million here. So cash flows have definitely declined. And in terms of free cash flows, looks like we're at about 30 to 40 mil of free cash flows. If I go to revenues, I still have revenue growth here, which is actually impressive in this environment, just because the restaurant industry is really getting hit pretty hard. So if I go 904 divided by 866, I'm still growing by about 4.4%. And food and beverage is actually flat on expenses, despite the revenue increase. That's very good. Labor costs, of course, up. G&A, flat, smart. They're keeping their G&A in line. That's good. Income from ops, net income 52 mil. That's not bad. They're actually generating net income. Other companies in the restaurant industry are losing money. And the balance sheet is looking like, what do I got here? Cash of 40. Accounts receivable brings me to maybe 110. What do I got in terms of debts? Big ones I've got $70 million of bills to pay, 220 if I include leases, and if I include expenses, I got $450 million of current liabilities. Long-term debt of another 471. 450 of long-term liabilities. They don't have the cash to cover this. The balance sheet is not good at Cheesecake. There is a massive lack of cash here. That balance sheet's actually kind of scary. And I didn't even include the gift card liabilities. Holy smokes. Yeah. I mean, okay, let's add together receivables, cash, which I generally don't do, but I call that 212, plus inventory 70. I'll be generous. I'll call it 80. I'll give them $200 million of cash. They got $200 million of cash, but literally 420 or whatever million dollars of bills to pay over the next year, not including gift card liabilities, and then long-term debt of another 471. They don't have the cash or the cash flow to pay these bills. They need to raise money. I wouldn't be surprised if they have. Cheesecake. Let me see here. Cheesecake. Let's see here if there's any news of an offering. Oh, the president. Sells shares of, president of subsidiary, Keith Carango, sells shares of Cheesecake. Oh, they're seeing a slowdown. Maybe, I don't know. Okay, so no, I don't see any. Let me look at their cash flow statement and I can see where they're getting money from. It's got to be borrowing. Cash used in financing. They paid dividends and they rebought a little bit of stock, so they're trying to keep the stock propped. Nothing from investing. Yeah, no, still, they're just milking the cash they have right now. Yeah, cash they have is going down. I mean, substantially, it's half of the cash they had last year, and it's declining. No, I don't know. The restaurant, there are going to be a lot of bankruptcies in the restaurant industry, in my opinion, over the next few, maybe like 9 to 12 months. The danger with that is could be a falling knife to get involved. So I think patience, especially if we go towards a recession, because I don't think restaurant stocks are fully actually pricing in a recession at this point. If we go towards a recession, I think you could see some real pain there. Oh, it's just unfortunate, but those are some nasty numbers. Somebody says I only eat the brown bread and butter. The brown bread is great, honestly. I'm the guy that's just gonna eat like the inside of the brown bread with a little butter on it, and then I'll leave the crust Sorry. But you got to get it fresh. You know, I'll tell you, the freshest bread I've ever had at a cheesecake is when I went to Cheesecake on an opening day. Or not an opening day, an opening time, right? Like right when they opened. And that was some of the freshest bread. That was delicious. Somebody's asking me about Mpox. Mpox is mainly spread through close contact with bodily fluids. Shared bedding, towels, clothing, through kissing, coughing, hugging, intimate contact, or kids, I imagine. Symptoms of the virus can include a rash that looks like a pimple or blister, but may be painful, itchy, fever, chills, exhaustion. Officials have not seen an increase in monkeypox cases in California. What is it? Like, the illness is usually mild. Oh, okay. Rash and blisters. And most individuals recover within a few weeks without treatment. Okay. So, are people dying from it? It's just a mess. Mpox. Current outbreak in the Democratic Republic of Congo. What to do if you're sick? Mpox typically lasts 2 to 4 weeks. Gosh, what a pain in the butt. Do not travel. Manage your symptoms. Rash relief. Preventing spread to others. Notify close contacts. Huh. Alright. Anyway, better go buy some hazmat suits. That'd be crazy. Oh, I gotta keep my thing up there. 7 a.m. Jackson Hole. Casey says, where do the lines come from on my charts? They come out of thin air. Brown bread from Outback Steakhouse is delicious also. That is true. Let's see. Very nasty. 1 in 50 mortality, I think. Okay, so about 2%. A rust hazmat suit. Exactly. Yellow hazy. Let's go. Sounds like you could get it on gym equipment. Only if the sweaty dude before you didn't wipe it all down. With an 800 credit score, what would stop me from refinancing if we go into a jobless recession? Fed cuts, mortgage rates drop, but I keep my job. I know banks will tighten who they will lend to. Well, not necessarily. Banks tighten when they fear that the type of lending that's occurring will lead to loss, right? So if you like I would expect personal loan financing to tighten up. I actually think refinance lending for people in your situation, 800 credit score with a job, would be totally liquid. My guess. Like, no guarantees, obviously, but that would be my guess. Like, I can't see them saying no to you. So, Kevin has the diet of a toddler confirmed. Hey. Just because I like sitting there eating fruits and nuts off a little $2 Target plate that's plastic and recyclable doesn't mean I eat like a toddler. Deutsches Brot von Bäcker ist das Beste. It's like a German and ist das Beste is like redundant. But yeah, German bakeries are pretty incredible. You know, what's amazing is German bakeries were actually the reason I realized Lauren was allergic to whole wheat. So when I started dating Lauren, we moved in together, I'm like, oh, you got to switch all this bread to whole wheat. Like, let's get you some healthy stuff. And she started having, reactions. And we're like, what's causing it? Like, she was like, nothing would have indicated she was allergic to bread. She had bread her whole life, right? And we went on a trip to Germany, and she had zero problems. And all we were doing was eating basically at the German bakeries for like 2 weeks straight, and beer. And then we're like, oh my gosh, what if it's the whole wheat? Because you've had literally no whole wheat. It's been like pastries and white bread and sourdough bread and beer. Yeah, we stopped whole wheat, and she started getting better. It was crazy, absolutely crazy, to think somebody could be allergic to whole wheat, but not wheat. That's a weird one, I'll have to say. Yeah. Somebody says beer is liquid bread in Germany. Yep. Back in 2009, 2011, many banks were dealing with financial losses and wanted to reduce their exposure further. They focused on making loans only to the most qualified applicants. Yep. Well, that was actually the foundation for the Dodd-Frank Act and the ability to repay. It's like, look, we still want to do mortgages, but because we know there are people who aren't affected as badly by the recession, so we're going to be more tight with, to whom we issue loans to. Somebody says, we are told to tell patients, cut out gluten, wheat, and dairy, and 97% of patients get better. Where is that, Corey? Told to tell patients. Is this at the dentist? Why would it be? Probably you got to be some form of nutritionist, or maybe GP. Someone here says, I have a Zoom meeting as soon as Jackson Hole starts. Shake my head. Honestly, so did I. I had a Zoom meeting literally at 7 a.m. because I thought Jackson Hole was 10 a.m. California time. And I had to quickly change it. I felt bad, given the other folks whiplash. Yeah, but how do you contrast that with $0 down, 0% interest for image? I have to look into that. That's the Gavin Newsom thing. Gavin Newsom, 0% down. Because, California, let's see here. California to assist with down payments for up to 1,700 first-generation home buyers. Is this the Dream for All program? Dream for All. This program provides potential home buyers with vouchers offering up 20% of the home's value for a down payment. I don't know if this is the program. And you have to get all of the details. Cal HSA, okay, well, yeah, you have to meet the income limits. Well, good luck pulling that off. 1,700 as well. Pretty low amount here. I'm not sure if that's the one. Oh, California bill could open new path to home ownership for Okay, here we go. What is this? AB 1840. Would expand the eligibility for the state's first-time homebuyer program, the California Dream for All Shared Application Program, to undocumented immigrants who live in the state. Yeah, that's just crazy. Okay, 5 minutes to Jackson Hole. So it is this program. And all borrowers must be first-time homebuyers. One borrower must be a first-generation homebuyer. Okay. Not to exceed $150,000. My gosh, dude. 20% down, $150K. I mean, that's like an $800K home or so. That's crazy, man. Income must meet the Cal HSF. I mean, this is going to be in such high demand. Good luck getting in on this. But it's worth trying, I suppose, if you meet the income limits. Oh, yeah, here's the income limit. Oh, there's shared appreciation? Oh, no, not shared appreciation. No. 198,000. I mean, you're going to meet that limit in Ventura County. That's crazy. That's pretty high, actually. Wait, where's the detail on the shared appreciation stuff? What is this? Borrower income. Program appreciation share is equal to 0.75% times the shared appreciation loan amount as a percentage of the home value. Oh, okay. So if you get a loan of the loan amount or the original principal amount, shared appreciation loan amount. Oh, that's their loan. Oh, so it's not even a giveaway. They're lending you the money. Homeowner pays back the original loan plus 15% of any appreciation in the value of the home. So it's a loan. And they're going to take some of your appreciation. So, like, if you have 20% appreciation over a period of time, and you got a $150,000 loan from them, and then you had 20% appreciation times 0.75, 0.075, right? Yeah, because that's 20%. No. Times 0.00. No. Times 0.75. Yeah. Okay, so you're adding about $22,500 to the loan amount then. It's kind of like another interest rate in there. So it's, okay, interesting. It's a loan for a certain amount of people. Your loan's going to go up in value because of the shared appreciation, assuming there is appreciation. Okay. I mean, whatever. It's, I think all this government, like the government wastes money pretty well in California, but that's not a surprise to anyone. All right. Bill.com down 9%. Tesla's at 2.7. Honestly, the Qs have basically just been flat. Yeah, I mean, look at that. That's pretty dang flat right now. I know it's got a teeny uptrend there, but mostly flat, just waiting for good old J-Pow. J-Powy wow. We are now just about 2 minutes away from J-Pow.
We are looking at a live shot of Jackson Hole, Wyoming, where in just a few moments, Fed Chair Jay Powell will take the stage to deliver his highly anticipated policy speech. We'll take you there live as soon as it begins. They now allow a camera inside that room. They've done that in recent years, but before that, it used to just be the text that they released. So clearly a lot of focus and eyeballs on this one. Good Friday morning, everyone. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live as always from Post 9 of the New York Stock Exchange. Stocks are rallying ahead of the Fed Chair's speech. We've got the S&P up more than 0.5%. Information technology at the top of the market, thanks to NVIDIA. A 3% rally will help the overall market. Remember, the company reports earnings next week on Wednesday. I've read some notes this morning saying NVIDIA just up there with the Fed Chair, Powell, as far as potential market mover. Communication services, the second best performer right now, but all the sectors are in the green. Take a look at treasuries ahead of the Fed Chair remarks, and we're seeing lower yields on the 10-year, 3.84%. Fed Chair Powell has just come out on stage to the podium inside that room full of invite-only economists, guys, set to deliver his remarks. Of course, we'll take you there live. We'll talk to Steve Leisman. But there's a lot of anticipation on this one that he signals a change in tone, that he's ready to start cutting rates in September.
By the way, really interesting take in the Times today about the origins of this symposium, how it started back in the Volcker days, Kansas City Fed trying to draw him there, loved to fish.
Fly fish.
Yep, and it's stuck, and it's literally smack in the middle of the Kansas City Fed district.
Yeah, the Grand Teton.
Yeah.
I mean, a lot of the other, I think, Federal Reserve districts have been jealous of the Kansas City and tried to do their own economic symposiums. But this has been the one because the Fed Chair always attends, and many in the past, including Greenspan and Bernanke, have used it, and Powell, as a way to pivot and talk about big policy change.
Let's get to Steve Leisman on the ground. Steve.
Fed Chair Jay Powell in a speech in Jackson Hole will say the time has come for policy to adjust. He goes on to say the direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance.
Market popping on this.
The balance of risk to our two mandates has changed. He says that less upside.
Oh, he's just reading. They're both reading off the same notes. I want to hear Powell, though.
Employment. Finally, he says, my confidence has grown. Inflation is on a path back to 2%. One quote I'll highlight, then we'll get to the chairman. He says, with an appropriate dialing back of policy restraint, there's good reason to think the economy will get back to 2% while maintaining a strong labor market. Let's listen to the chairman.
Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%, still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon, reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade. But labor supply remained constrained, and in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage, and inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023, and we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
Oh, use the iPad. Okay, that's interesting. That's it?
Sadly, no
That's it?
Q&A.
No questions or anything? Wow. Okay. I mean, not a lot of guidance there in terms of enthusiasm. I was expecting to see a little bit more than that. Wow. Okay, that's it. Very interesting. So what's missing there? A lot. I'm gonna write this down really quick. This is very interesting. So what I find that's missing is, oh my gosh, I mean, so much. Okay, so no talk about, basically, or no talk or implication about 50 or 25. We basically, I mean, we barely got anything on the bingo card, No talk about peak rates, no talk about soft landing, really. I mean, this was more of like a history almost, I feel like, it's sort of like we got we got like a little bit of insight and of like, hey, we messed up. We said inflation is transitory, and then it's not. Yeah, we're close to cutting. Okay, but we kind of already knew that. We kind of already knew we were going to get 25. Now, I will say something that I think was bullish was Jay Powell's talk on the labor market. He specifically said, check out Kevin's flash sale at meetkevin.com because it expires today in honor of J-Hole, and get all his trend alerts or stock trade alerts when he makes that trade, and sends an alert. Okay, look, in seriousness, this is what I wrote down. Let me put this away really quickly here. Okay, there we go. So this is what I wrote down. So I wrote down, task is not complete. We don't seek or welcome further cooling in labor markets. No, we didn't get any talk about revisions, right? No talk about revisions or detail here beyond this. But frankly, this comes across as somewhat bullish because it means Powell is indeed paying attention to job stress. However, it also makes you think, wait, wait, how bad is it, bro? Right? So, like, I don't know. I was it bullish? Was it bearish? Like, I mean, we knew we were gonna get the 25 BP setup, right? So we knew we'd get a 25 BP setup. Which we got. We just didn't get much more detail other than, a real concern highlighted for the labor market. That was obvious. Very clear concern for the labor market. Now, I guess my question then really comes down to if, what is he seeing? How bad is it? I don't know. Let me listen to them for a moment over here because I'm a little torn.
It was a question I asked him in July. Would this be a process? And he suggested yes, it would. So now he's sort of come.
Yeah, I was expecting slow and steady, not we need to cut. Exactly.
Discussion about inflation, the history part, which is less interesting from a news standpoint, but more interesting from a standpoint of policy going forward, is one we're going to say, hey, what did we do right and what did we do wrong here? He sort of said, we didn't get the transitory part right, but we did keep inflation expectations under control, and we addressed it correctly with policy, and now we're at a place where we're going to be adjusting that policy. The missing thing was, how restrictive does the Fed believe it is right now? How far can it go? How far does it need to go in terms of getting a policy to the right place? That's going to be the debate inside about exactly where we're at in terms of where that neutral rate is. That was not part of this discussion. It's probably part of the next discussion.
Steve, people are looking back to the speech 2 years ago, and Sarah mentioned this briefly, where he said that the the working until the job is done would bring, quote, some pain to households and businesses. What do you think his characterization of the pain that we did sustain would be?
I'm glad you brought that up, Carl, because I had that pull quote. Guys, I don't know if you can bring that full screen up. He said, with an appropriate dialing back of policy restraint, there's good reason to think the economy will get back to 2%. While maintaining a strong labor market. So effectively, he's backing off that pain prediction. And he's that's the kind of saying, hey, I think we can do this soft landing thing. we didn't really have to have as much of the pain, other than, of course, the inflation pain that he talks about, but did not have to have the joblessness. And so now he's saying, you know, we do not welcome further weakening in the job market, so we can cut it off here, make that adjustment, and maybe get out of it. You know, how does the Fed do this soft landing? Well, it's tried a couple times. It's maybe made it once, and not all that often has it succeeded. So this will be pretty historic if they pull it off. And he's kind of telling you, I think we can do that if we adjust policy now.
One other reason for the market move, and Neil Dutt is just pointing this out from Renaissance Macro, Steve, is he did not use the word gradual, unlike some of the other speakers that we've heard on the Fed. In other words, he's not taking off the possibility or the option of doing a larger move if they feel like they have to do that.
I think that's fair. He did sort of hedge that idea of the timing and pace. But I think, Sarah, the other reason for the market optimism is his idea of adjusting policy was unhedged here, in a sense that it creates scope for, let's assume next month, and on the downside, we get a 0.3 on inflation. I don't think that changes the idea that the Fed can cut rates, become less restrictive, and yet remain restrictive. I think what we're talking about is the next series of data points are going to adjust, you know, how far the Fed goes, how fast the Fed goes. But when he says this line, it's very direct. The direction of travel is clear. That's an unhedged statement. And I wonder, Sarah, if the market was perhaps thinking the speech itself would be a bit more hedged.
Certainly a possibility. I mean, pretty broad rally we're seeing right now across the board, the semiconductor equipment on top, but also some of the sectors that benefit from lower rates are rallying really hard. The home builders, for instance, the home improvement stores like a Home Depot, consumer discretionary is having a really nice day. Technology's on top again, though, Carl, because NVIDIA is up 4.2%.
We're going to talk more about that in the coming days. Steve, I wonder if you think his speech primes the market with the ability to absorb a downside surprise on August jobs.
When you say downside, do you mean a weaker than expected surprise, or a hard? Because it depends on which side of the trade you're on, obviously, right?
Yes.
You know, that's like when I see these notes about a bad day for oil. I think that's a good day for oil when there's a bad day for oil. But I think it does. I think that a downside surprise is something that would make you lean more into the 50. You know, about even would say, okay, we're going to do a 25 here. And an upside surprise, I think, is less consequential in the sense that, again, I believe he's put a kind of parameters around the idea that we're cutting rates if data is going to come in within a tolerable range here. Obviously, a huge upside surprise on the inflation data.
Let's try the doomers. And then we'll give my thoughts here.
Basically, with this speech and certainly with the July meeting as well, they've been heavily signaling that they're going to make this move in September and subsequent moves. So that's already been priced in the markets. So they'll just be confirming at the September meeting what's pretty much already happened as far as market pricing.
Jim Bullard, the former St. Louis Fed president, thank you so much for being with us following that speech from Fed Chair Jay Powell at a time where markets are screaming higher. You could see that really advance. 2% on the heels of confirmation of the rate cutting cycle
crisis
beginning.
Over.
Well, is it crisis over, or is this a new emphasis? How far will they go? A lot of questions around that. We will continue to, of course, play that parlor game simply because the data dependency lives on, and that's what will determine the pace of the cuts.
Here we are with an event, and then the next event, I believe, is September 6th, which is not back to school. It's a jobs report. And, you know, after the shock of 114, and, of course, the revisions off that, the revision here, you know, I guess we knew it would be important, but maybe off the speech and the market move, it's ever more important.
Yeah, you're seeing the market move across the board through bonds. You see yields lower across the curve. 2-year yields down some 7 basis points, which is more than the average of 5 basis points on Jackson Hole Fed speech day. Coming up, we do have the hosts of Bloomberg's Odd Lots podcast. We have Tracy Alloway and Joe Weisenthal, plus Dana Peterson of the conference board. We're going to be dissecting the speech and what that means for the path ahead. This is Bloomberg Surveillance.
Yeah, let's look at Nick T here. I'm just sort of gathering, you know, what everybody's reaction is to this one. So far, I have not heard my labor concern from anyone else. So Nick T just tweeted, the Powell pivot is complete. Let's write that down. So let's go Nick T. Let's write down what he says. Powell pivot, the PP, is complete. Powell's dovish across the board. Yeah, I agree. From the same stage where 2 years ago he signaled the Fed would accept a recession as the price of restoring inflation. Right, that didn't happen here. The cooling in the labor market conditions is unmistakable. Let's take a look at the market, by the way, here. It seems to be topping right around here, by the way. So the question is it going to be able to keep rallying past this? This is what people are looking for right now. It seems to be about the 482.5-ish line, 482.5-ish. So this was right after the speech, and then you've kind of just been hitting a ceiling over here. So we'll see where the Qs, what direction they really want to go in. They are consolidating a bit right here. Wow, look at the mortgage companies. Loan Depot up 7.45%. Rocket Mortgage up 2. United Wholesale 2.7. IWM Small Caps up 2.5 as well, kind of like with the mortgage co's. Enphase, Tesla, your interest rate sensitives, nice. Tesla's right, almost back to that 221 level. Not bad. TLT up 67 basis points. Wow. All right, so we'll see what direction this goes. Okay, so in the meantime, it seems unlikely that the labor market will be a source of increased inflation pressure anytime soon. That's true. We do not seek or welcome further cooling. I mean, these are all the labor market items I wrote down. So he's knocked those. And then other memorable lines. Powell unfurls his narrative on the causes and behaviors of inflation, recognizing not everyone will agree with his framing. He concludes, my assessment of events. This is my assessment of events. Your mileage may vary. After, basically talking about transitory inflation. Okay. Interesting. Very interesting. So, let's see if there's any other commentary, and then we'll do a summary here. I think that's summary and implications. Yeah. Okay, this is another, interesting takeaway is basically, we confirmed the September cut. We kind of already priced that in. Doesn't indicate whether it's 25 or 50, so that's why we actually saw a little bit more pricing in of the 50. And so it basically puts more weight on the August payrolls report, but it means the Fed is responsive to it, right? So more weight on August payroll report, but implies Fed is responsive to that. Let me go with, let's see here. If I go jump to the calendar quickly, I'll be able to see September 09/15. I'm gonna go with labor comes out on the 5th. Jolts on the 4th. Okay, labor data coming up. Let's write this down. So we've got Jolts on 09/04. ADP on 9/5. And change in non-farm payrolls on 09/06. Okay. All right. I mean, this is interesting. Let's try to summarize this and understand this. Take a quick look at what some of y'all are saying here in the chat, and then I want to do a let's see here. Yeah, we do not welcome further cooling in labor market conditions. That line is great. It absolutely is. Absolutely is. Kevin, did you see that massive new home sale data beat? Was that today? New homes. Oh, yeah, new home sales month over month up 10.6%. That's pretty good. What labor concern? Yeah, I will explain. First name, last name says, the alert template is very helpful and much more clear to read. Thank you for standardizing. Yeah, you got it. Absolutely. Yeah, I just thought I'm going to try to speed up how I'm able to post it. Just for those of you who aren't aware, what I'm doing now is I make a little template. So it just very clearly, when I send a trade or trend alert or whatever, it just follows a consistent format. And so folks have found that to be pretty useful. Okay, so this is very, very interesting. Let's have a discussion about this. And I guess it's official. J Powell has flipped. Okay. Yeah, and I'll give you sort of an update on the bear bull scale too. And let's see here. Let's see. Okay. So we will start here in just a second. Somebody's, let's see. I want to see what's going on really quickly here. Look at this. Look at this Tesla. It's perfectly rejecting at the 221. This is so classic. Bill.com is still down 8%, 6.5% down on Intuit. Tesla, yeah, let's see if it can break through there. The Qs are really getting stuck in this range. It's gonna be interesting to see which way it goes. Peloton was down like 4% at the opening, and that's rotated. Holy crap! Look at Redfin. Oh my god, dude, line to line. Are you serious? From 9.39 to 10.92, literally line to line. Oh my god. Wow, what a rally, what a rip. Yeah, like, yay, LDI's up 8% and United Wholesale and Rocket up 2%, but damn, Redfin. That's crazy. And what the irony of that is, if it's moving off of new home sales, no, that's Powell. No, it's pretty much all Powell. Yeah, because Redfin agents don't sell, what's it called? They don't sell new homes. I mean, I guess maybe a small chance a buyer's agent can help, but that's very unlikely. Yeah, everything got pretty excited there. Oh, Ubiquity's almost flat. They were down a chunk this morning. At one point, they were down as much as 7%, and now they're flat. That's crazy. Wow. Okay, well, that's great. What about Apple? Take a quick look here at Apple, Amazon. Amazon. Yeah. Okay, both of those up about 1.3-ish. Enphase broke 119, says someone here. I think you're right. Let me see here. Oh, yeah. Oh, yeah. Nice. Yeah. Now, the question is, well, you'll see in my chat here where my head is on this. Oh, boy, oh, boy, oh, boy, oh, boy, oh, boy. I don't know how to say it, so I'm just going to say it. All right. Let's go. Flip on over here. And oh, hold on a sec. Okay, that's fine. All right. Yeah, let's just get to it. All right, here we go. It's this button and this button. There we go. All right. Hope you don't mind the mic. Wow, this was a dovish Powell. Jerome Powell literally just flipped. In this video, I'm going to give you a bear bull scale update from Kevin. I'm going to tell you what Jerome Powell said in reverse order. And I'm going to give you my opinion, which I haven't heard anybody else talk about yet, which is either a sign that nobody else is paying attention to it, or it's a sign that your boy Kevin is just a dumb idiot and is just totally wrong. In this video, I'll give you everything that's on my mind, and I'll let you make the decision. So, let's get started. Jackson Hole. Jerome Powell starts by saying, Kevin's got a flash sale today over at meetkevin.com in honor of Jackson Hole, and the prices go up tonight. Got any questions, email us at staff@meetkevin.com. Otherwise, check it out and make sure you get in before 11:59 p.m. We finally figured out how to make the computer automatically kill the price increase right at 11:59 p.m. So check it out at meetkevin.com. With that said, Jerome Powell truly did say, the task is not complete, and we do not seek a further welcoming or a further cooling in labor markets. So we do not seek or welcome a further cooling in labor markets. This is actually really important. This line, in my opinion, was critical because on one hand, I've been screaming on the channel that I think the Fed is going too slowly, that if they keep moving this slowly and gradually and methodically, they're going to cause an unemployment recession, and that is going to be different than the recession we expected at the beginning of 22, where at the beginning of 22, we expected a recession where people would have excess savings and they'd have their jobs, and it would sort of be like a shallow, okay, yeah, year-over-year growth is slower, and you'd have a recession. Really, what we would end up getting if we had a recession now would be a jobless recession where companies start laying off more because they're trying to increase margins. CapEx spending slows, then layoffs occur as hiring stalls, then you get consumer spending slow down, and then the data shows up in unemployment. Unfortunately, I've been concerned that if J. Powell waits for the data to show up in unemployment, it'd be too late and we'd be knee-deep in a recession. So this line from Jerome Powell that already at this point we, quote, do not seek or welcome further cooling in labor markets is actually good. But there's a balance to this. Because on one hand, I'm like, oh, I literally wrote down, I may have even said it on the video. When he said that, I'm like, oh, that's good. This is, I think I just wrote it down. This is bullish. J. Powell is paying attention to the labor market the way he should. This is a good thing. But then I started to thinking to myself, wait a minute, how bad is it, bro? What do you know that you're not saying here? No, I understand that that would be very, very jaded to assume that J. Powell's starting to go, oh God, we've gone way too far. But let's listen to what else Jerome Powell said and see if maybe there's another clue as to J. Powell saying, oh, we've gone too far. Let's see. Jerome Powell tells a story about how he and other economists and central bankers and analysts were on ship Transitory, and that it was a very crowded ship. And he basically makes the case that being on ship Transitory was the right move. It just took longer than expected. The journey was longer. Okay, what is he trying to say with that analogy? Well, he's trying to tell you, hey, look, we expected inflation to come up and come back down. And then once it was gone, we're done. By him using this analogy, he's basically trying to say, we were right, it just took a little longer. Inflation went up, now it's down. We're not worried about inflation anymore. Now we got to fix the labor market we just screwed up. That's my implication from this. Again, your opinion may be very different, and that's okay. That's the beauty about finances. We can have different opinions. So then he says, we will do everything we can to support the labor market. The time has come for policy to adjust, and there is ample room to respond to risks. Okay, this is really interesting because he's basically saying inflation's not a problem anymore. We're now serious about the labor market. I actually don't think the Fed is balanced anymore. Like, in the last FOMC meeting, the Fed's like, yeah, we've gone from inflation as a priority and the labor market's okay. I think we've actually gone, in the last meeting we went to, okay, they're both balanced. I think now we've gone to, bro, inflation's over, which I agree with. Mind you, I completely agree inflation is over. There's not going to be a second wave. This is my opinion. Talk about that in many other videos. Supply chains have expanded so much that it's going to be very difficult, even with stimulative spending, for us to see a second wave of inflation. My opinion, again, yours could be very different. Okay, so if inflation is dead the way J. Powell is saying, and now he's basically more in favor of, oh man, we may have gone too far, we may start causing some real damage to the labor market here. and this is why he's coming across so dovishly, then we have to ask ourselves, okay, so how do we internalize this? Is this a good thing that he's being dovish? Yes, it is a good thing. Because if he came out today and said, we're going to go slow and gradual, we're not convinced inflation is dead, well, then we'll almost certainly be in a recession. So this speech is definitely more bullish than bearish. But now it kind of like the rapidness, is that a word? I don't know. The rapidness of him going from, we're not done yet with inflation to inflation's transitory and oh my God, we need to save the labor market. That flip makes me go, man, I mean, this is good that now you're paying attention to the labor market, but now you got me a little concerned as to how concerned you are about the labor market, because I've already been freaking out about the labor market. And now you're freaking out. And so I'm like, are we already in a recession? I'll update the bear bull scale in just a moment. But these are, I don't know the answer here. I think really the data will help us, obviously. We got to be, where's the word? Where is it? It's somewhere over here. We got to be...
data dependent.
And we do have data sets coming out here soon. We've got JOLTS coming out on 9/4, job openings and labor turnover survey. The ADP private unemployment report will come out on 9/5. September 5th. And then we'll have non-farm payrolls on September 6th and my dad's birthday on September 10th. Okay, so let's keep listening to what he said. So in addition to this, he says, we've made a great deal of progress and my confidence on inflation has grown. The upside to inflation has diminished and the downside to the risk of employment have increased. So I actually wrote next to that, I'm like, how badly? Like, how badly have the risks to employment increased? Anyway, so labor market is unmistakably cooling, says Powell. The timing and pace of cuts will depend on the data. I wrote this is surprisingly bullish on the labor market. Unlikely the labor market will be a source of further inflationary pressure. We already knew that. He's already told us for a while that there's no wage price spiral and we're not really concerned about wage gains. In fact, some wage gains are consistent with falling inflation. So that's fine. He referenced 2023 as an example of that in the second half when inflation was plummeting and wages were actually rising. Then he says, sometimes it can be a good idea to look through inflation as transitory. And so he sort of goes back into history and says, like, it's kind of normal. The problem this time was that supply chains didn't recover as fast as we thought they would because of the COVID shutdowns. He does think we're on a sustainable path to 2%. And then he ended the meeting. And we're like, okay, that was like a 15-minute speech or maybe even slightly less. And we're like, we didn't really close the door to 50 basis points there. So what happened is the market has actually started pricing in a little bit more of a chance of 50 basis points. If I look right now, when we started before the meeting, we were at about 1.25 cuts priced in for September. Now we're at 1.32 priced in. So the market's pricing in a little bit more in terms of rate cuts. We're pricing in a full 5 rate cuts now for January. So he's kind of actually left the door wide open to 50 here, which again is good. In my opinion, this is what he should be doing. But then I also wonder how quickly he U-turned makes me just scratch my head and go, this is what you should be doing, but bro, is this worse than you're leading out here? What's going on back there? I feel like I'm getting a report from the engine room of the Titanic. And, 20 minutes ago, it was, we're fine. We got it all under control. And then 10 minutes ago, it was, it's a little worse than we thought, but we got it. And then 2 minutes ago, it's like, yeah, man, we got some problems. I don't know, man. That's a little bit like I'm getting whipsawed here by the flip-flopping from the Fed. I mean, again, 2 meetings ago, inflation's still not at target. 1 meeting ago, it's the risks are balanced. Today, it's there ain't no more inflation risk, man. The jobs market going to shit. Which, we already knew that. Okay, anyway. So then he says, the direction of travel is clear. The meeting ends. Left the door open to 50 basis points. No talk about peak rates. They're not going to raise rates anymore. No talk about a soft landing. There's no question this is dovish. Now I'm just wondering, why is it so dovish? Nick T says the Powell pivot is complete. And so where am I on the bear bull scale? I'm up a little, but this is not much. Not as much as you might think. I saw some of y'all guessing. You're like, oh, Kevin's going to be a 7.5. Where max bullishness with margin is 10. Some people are like, nah, Kevin's going to be a 5 or a 6. I'm going from 2.9 to 3.3. Okay, so because A, this is what he should be doing. This is good. Yes, Powell. Yes, this is what you should be doing. But the rapidity of flip here just has me like minimizing my bullishness going, is it really that bad, bro? So we'll find out as we get more data. I'm just saying. I'm a little freaked out, okay? So I don't know. I guess the data will tell. I will tell you what I think. What I think will be a winner, no matter what. I'm just going to be transparent here, okay? What I think will be a winner, no matter what. Ooh, damn. That option I placed and sent a trade alert on. Let's freaking go. Damn, baby. Woo! Just before I started doing this video, I had an option trade that I placed, and it's making some dollar hollers right now. So, hell yeah, let's go. Okay. Anyway, that's up like 50%. If you want all those trade alerts, make sure you use that flash sale coupon code. Let's go! But Nick T, he says the Powell pivot is complete. We've got a lot of people on CNBC and Doomberg that are like, oh, yeah, this is dovish. This is great. A dovish Powell. Wow, wow, wow. I'm like, y'all miss what he actually is did y'all miss the big flip-flop here? I don't know, man. Y'all freaking me out. That's all I got to say. That's all I got to say. So anyway, thank you so very much for being here. I appreciate and love y'all. Folks, holy crap, that option it doubled. My option just doubled. Holy sh. Let's go, boys. Woo! Anyway, you want to see those trade alerts, make sure to join me in Stocks and Psych over at meetkevin.com. Flash sale coupon code ends today. If you got questions, email us at staff@meetkevin.com, and we'll see you in the next one. Goodbye, good luck.